So the trade talks are happening, and we have to talk about the first country in line, and that is Japan. I think by now we know what is at stake. Japan faces a reciprocal trade tariff of 24% across the board, which is really brutal for even a US ally. In addition, there's also the steel and auto tariffs of 25%. So even if the world gets hit with a 10% tariff during the 90-day pause, Japan still faces very big punitive tariffs from the US. And here's the funny part, even China was given exemptions because of how critical their imports are. 81% of US smartphones comes from China, and those are exempted. 26% of computers and 78% of monitors are from China as well. Those are also exempted, and in total, the US exempted over $100 billion worth of goods from China because they simply couldn't replace those. 26% of total US imports excluded from the reciprocal tariffs. And if you're Japan, you want zero tariffs on your goods as well, but your supply chains are not as integrated as the US with the Chinese economy. Apple isn't making smartphones in Japan and shipping them back to California or to New York. So you just don't have the leverage here. Japanese steel can be replaced, and Japanese cars aren't a critical export to the US. Japan exports the second largest volume of cars to the US market. Mexico is first with nearly 3 million vehicles sold last year at over $78 billion worth. Japan is number 2 with 1.3 million vehicles sold at around $40 billion worth. If Tokyo doesn't fall in line, they could lose nearly 10 to 15% of their total export market. And that's how crazy the dependency is on the car market and on the US. But there's also another problem. Automakers in Japan can't eat the tariffs. Their margins are ultra thin. The cost of production in Japan is just too expensive. If Toyota eats the tariff, they will suffer a 30% collapse in operating profit. And this is Japan's strongest car maker. For Nissan, the outlook is even more dire. The cost of the tariffs equates to over 300% of their operating profit. So Japan has to negotiate with Scott Bessent because if they don't, it's either a collapse in revenue or crash in company profits. But there's a catch beyond just the tariffs.
Here's where we think the tariff levels are: non-tariff barriers, currency manipulation, unfair funding, labor suppression. If you will stop this, we will not put up the tariff wall. If you do, then we will put up the tariff wall to protect our economy, protect our workers, and protect our industry.
For Japan, the big elephant in the room is the currency. Does the US want Japan to strengthen the yen to crash the export market? It's ironic because the US might just want Japan to sacrifice their global export capability again to help boost US exports. Here's where Tokyo is trapped. Bessent wants to talk currency during the negotiations, and the consensus in Washington is very simple. If foreign currencies are weaker than the dollar, it gives countries an unfair advantage to foreign firms exporting to the US. Now, whether you believe this or not, it really doesn't matter. All that matters is what Bessent believes. And here's the crazy part. The US dollar has been crashing for over a week. We are now below 100 points and we are headed down to the lows in 2023. So US exports have been getting cheaper. If we look at the dollar yen chart, Japan's currency has been appreciating since January. A huge drop in dollar strength in April pushed it all the way up to 142. But the US might want to go further to get Japan to do another Plaza Accord and strengthen the yen even more. This will be disastrous for Japan because their exports will get less competitive, not just to the US, but to the world as well. And Japan has to ask themselves a very big question. Is selling to the US worth it if I lose business around the world? Is the US economy going to grow much faster than other economies? And we can expect Bessent to throw Japan a very raw deal to lowball the Japanese to get what Trump wants. That's the art of the deal. But if Bessent demands Japan strengthen their currency even further, the mechanism of how that works is very important as well. Normally, the knee-jerk reaction would be to sell US dollars and buy back the yen. Japan today owns over 1 trillion in US Treasury bonds, more than any other country on earth, more than China, more than the UK, and almost 3 times the amount of Canada. Japan dumping these bonds today would be unthinkable, especially given what is happening in the US bond markets. yields have been already spiking up. So if a devaluation were to happen, it can't be at the expense of the US bond market, which puts Japan in a terrible position. The only way left to strengthen the yen to make their exports less competitive is to raise interest rates. But can the Japanese do that without blowing up their entire economy? Just last year, Japan's government debt to GDP stood at over 250%. That's a crazy amount that sandwiches them into a terrible dilemma. If they don't hike rates, they could lose access to the US consumer market. Less cars will be sold to American consumers. But if they do hike rates, this could cause their interest payments to spiral out of control. And that could reinforce the deadly cycle of issuing even more debt to delay the implosion. So this is one big horrible situation to be in. But let's talk about the resource war for a bit. Now, ever since Trump started his trade war, two things are very apparent. Major countries are fighting back on the reciprocal tariffs, plus the US is facing an extreme shortage of critical inputs for their own manufacturing. And now we have a shocking revelation that countries are working together behind America's back. And it's not BRICS, it's China and Canada increasing the most vital trade of them all. China has officially pivoted from US crude to cheap Canadian oil. Chinese refiners have slashed their purchase of US crude by roughly 90%, and this was done in March. This was even before the big tariff escalation between Trump and Beijing. So, in the months ahead, we can see US oil exports to China drop to zero. Canada opened a pipeline expansion in the western part of the country, and this allows China and other Asian buyers to buy Canadian supply for a win-win scenario. Canada gets to diversify trade and earn more, while China gets another supplier that is not the US. This is an incredible pivot because China used to import 30 million barrels a month from the US at the peak. But now they are shifting demand to the Canadians. They just bought 7.3 million barrels in March, three times the volumes of their US crude imports in the same month. That's billions of dollars in revenue loss. The US will have to sell to other customers at a lower price because the biggest consumer of crude just isn't buying from them anymore. When China imposed their 125% counter tariff, that made almost all US imports unviable. And this includes commodities such as agriculture and, of course, oil. And as we said before, waging a trade war with Beijing isn't that straightforward. China's tariffs will target critical industries and precious revenue will get cut off. Now, take the US propane market for example. China was busy wrapping up their plastic production and they filled it with US propane. But now buying from America is unfeasible. As a result, US propane market has utterly collapsed thanks to a glut of supply. It has gone from 90 cents a gallon to just over 60 cents, a 33% crash. Now, we know Trump wants to turn US industries into an export powerhouse, but if you lose the world's second biggest economy, it's a disaster. Where else can the US sell their energy exports to? The EU is still struggling, and Japan is only one country, and Asia is just too far away. It's cheaper for them to buy Russian or Middle Eastern oil. And despite the sanctions, tariffs, and pressure, one of China's fastest growing sector is still their industrial production. This is a $5.6 trillion industry and it's growing at a rate of 5.7%. It's bigger than even their real estate, construction, and financial industry combined. And that's why people call China the world's factory. For an energy producer, having Beijing as a customer is like striking gold. You can export oil and gas to power factories as well as input for Chinese refineries as well. But thanks to the tariff war, China has effectively cut away US energy imports, and this is bad news for US producers who need to sell oil above a certain price to stay afloat. And this is called the Goldilocks zone. The 10% reciprocal tariff doesn't just jack costs up for the US consumer, it increases the cost of production for big oil as well. Everything from drilling bits to the steel needed to make all the hydraulic machines all rise in price. And when costs rise higher but oil prices comes down, now you have a very big problem on your hands. According to the Fed, the average break-even prices across the US is between $61 to $70 a barrel. We are currently sitting at around 62 to 63, which means many wells today are unprofitable to operate. We know the odds of a US recession are exceedingly high now. Oil prices are already showing us this is becoming even more likely than before. And as global crude prices start to collapse, US producers will lose a ton of market share to the Saudis. They will lose a lot of market share to the Russians. Their break-even costs are less than $20 a barrel in most cases. And besides just lost revenue, China buying more oil from Canada increases more bilateral trade, which means the opportunities for de-dollarization just went through the roof, and the future of the reserve currency just got a little bleaker. Just last year alone, Canada's trade with China reached $127 billion, and that's on par with other non-US G7 countries. Sure, the US trade reached $1 trillion with Canada, which is huge, but the tariff war threatens to flip everything. China will start buying more volumes from the Canadians, and that will prove to be a double whammy for the US economy. Firstly, they lose a cheap supply of oil. Canada sells their crude to the US at huge discounts, so now their industries are more expensive to operate. Secondly, Canada and China will be more than happy to de-dollarize. They will trade in either the loonie or the RMB and deal yet another blow to dollar hegemony. Now, I'm not saying that this will crash the dollar tomorrow, but the trend will get much worse the longer we stay in this trade war limbo. The genie is out of the bottle and there's no putting it back. So Trump's trade war with the world is more complicated than he thinks. There are many blowback effects not just for the US, but for countries looking to negotiate like Japan. Even a Japanese lawmaker called the tariffs a delinquent kid extorting somebody, and how bowing down will create a very bad precedent. And that equation of the tariffs itself just doesn't make sense. But Trump is going to squeeze Japan because he believes the US is still getting the shorter end of the stick. So Tokyo has to brace for impact.
We have a deal with Japan, and we get along great with Japan, and we had the Prime Minister here. He was fantastic. We defend them, but they don't have to defend us. I said, that doesn't sound too good. But we have a deal, where a defense deal. We pay hundreds of billions of dollars to defend them, but if for any reason, in other words, we pay all the money. They don't pay anything. But if we're ever attacked, they don't have to do a thing to protect us. I said, oh, that sounds like a wonderful deal.
So how the deal will end, we have no idea. But if Japan doesn't negotiate well, they could end up with a Plaza Accord 2.0, which will contribute to yet another lost decade. But let me know what you think. Will Japan get forced to strengthen their currency even more? And will Canada sell even more volumes of oil to China? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.